Welcome to another episode. My name's Jose Najarro, and today we're going to talk about 401ks. So let's get started. So what now? So in the last episode, if you guys watched last episode, we talked about ETFs and expense ratios. And I also mentioned that expense ratio is something that you see in your 401ks, and it actually helps. It actually takes money away from you depending on what kind of expense ratios you are. So in this class, we'll talk more about the expense ratios that are in 401ks and how I make sure to save my money by not paying the high amount of expense ratios. So this is my 401k funds. These are the 401ks from my company that I work at, and these are the funds available in here. Usually, if you have a 401k with if your company has 401k has a 401k, these are the type of funds you're going to see. The first type of funds are going to be target date funds. So target date funds are funds that determine when you're going to retire. Let's say me at the age of 27, I still have about 35 years to retire. Then my target fund would be either 2055 or 2050, depending on when I think I'm going to retire. The next are index funds. So if you guys have been watching episode 1 and episode 2, you know that index funds are my favorite things because they have the low expense ratio and they have such great returns. Here you can see a big check right here in the S&P 500 equity index fund, so you know where my 401k funds are currently at. Then the next you're going to see is actively managed funds. So actively managed funds is when someone tries to beat the market. So obviously, if someone's trying to beat the market, they're constantly switching out of assets, switching out of investments to make sure that they have the best returns, better than the overall market. But obviously, since someone is doing that, they cost more. So next, let's take a look. If you're in your 401k, you could probably see a button that clicks fees. I clicked on my fees, and it gives me the expense ratio for all these. First, the lowest expense ratio here would be the S&P 500 at 0.01%. So let's just and then we have the target rate funds, right? So the target date funds, let's say for my 2050 fund, it's a 0.05%. I was actually looking at my previous company, the gross expense ratios for target date funds were a lot more expensive. So I was actually pretty glad to see that these are 0.05. I remember at my old company, the target funds were 0.5. So there was no zero after the point, where here there is a 0.05, and that makes a big difference. And then you can see the actively managed funds are sitting much higher, where the cheapest is sitting at 0.2%, but there's some at 0.3%. So let's say, let's make an example of 0.01%. Let's say 0.01%, let's say was $100. So the S&P 500 is charging me $100. If that was the correlation, then my target fund rate would be charging me $500, right? So would you rather pay $100 or would you rather pay $500? The actively managed funds you're actually paying $3,000. So what would you rather pay? You would rather pay $100, $500, or $3,000. And I just want to say those are not the actual numbers, right? It's not. It's dollar per how much you have, is percentage per how much you have invested. But that's a great easy way to see like the difference between the gaps of price. So you can see, right, I personally like the S&P 500 because I think you get the best returns from there. So let's talk about the expense ratio. So like I mentioned, the expense ratio is the expense percentage times your total investments will give you the cost. So let's say you had $1,000. The expense ratio of 1% is $10 a year for every $1,000 invested. So hey, for every $1,000 I have invested, I'm only paying $10. I'm gonna be like, hey, that's actually not a bad deal. It seems like a little bit of money. But if you guys saw the last episode, you guys remember this chart. This chart I got it from mindfullyinvesting.com. So if you guys wanna learn more, they're there. You can check them out. But here, this chart does a great way of showing expense ratio. So this is an investment of $10,000. So it's not like your 401k where you put on money every paycheck. I'll do one after this, but this is just to show expense ratio and how it works, right? Expense ratio for an initial investment of $10,000 with a 9% return. So it's a 9% return a year, which is the average about the stock market. 10% if you don't count inflation. So if you have 0.04% expense ratio, you make over $145,000 in 30 years out of your only 10,000 investments. If you do an expense ratio of 1.31, look at that big gap. From 145, it drops to below $100,000. So you make so much less money by having just a 1% expense ratio compared to if you had almost a 0% expense ratio. So let's take a quick look at target date funds. So remember, I mentioned my company's target date funds were actually pretty cheap. So I ended up just looking at the average price for target date funds. And the average rate in the United States in 2016 was about 0.5%. 0.5%, like I mentioned, that's what I saw at my old job. At my old job, there was an expense ratio of 0.5%. But these fees can range from as low as 0.1% to more than 1.5%. So there's room to shop around. So some target funds are as high as 1.5%, and the average is 0.5%. So now let's have some fun time. Ha ha ha, get it? Fun time, but we're actually talking about funds, but not fun. All right. So now I did a different chart. I have a fund that you charge 0.01%. That 0.01% matches what the S&P 500 equity fund that I have at my job matches, so 0.01%. Then we have a fund of 0.51%. So remember, 0.51% was the average in the United States in 2016. So this is probably what some of you guys are looking at. So I want to do something average. Then we have the 1.5% because there's some as high as 1.5%. And if you do an active managed fund, there's one here at 1.3%. So I just want to show again how a high fund like that can work. So this is how it goes. There is an initial investment of $10,000. We're going to be assuming 10%, which is the average stock market return. And every year you deposit $5,000 into your 401k. So I don't think $5,000 is unreasonable. Let's say your company matches your returns. I think $5,000 is doable for many Americans. So I did numbers that I felt can be done by others. So let's see how this is going to look. In the fund, which has 0.01%, the amount of money you will have in 30 years will be over $1,050,000. So look, you can see that right here, $1,050,000. If you have a fund that charges 0.51%, you're going to have an account of $969,000. So that's almost $100,000 less by that. And I actually didn't think, obviously $100,000 less is a lot more money. I thought it would be more impactful though. But look at this. If you have a fund that's 1.5%, you have $790,000. You have made $300,000 less than someone else. And you're not even doing anything, right? Because these are just people actively doing it. So by just charging that, by paying that extra percent, you're just depositing the same amount of money as, let's say this was me, Jose, and this was Billy, and this was Bob. So Jose deposited the same amount of money as Bob and Billy, but he ended up making more money by absolutely doing the same thing, except just on a different fund. So you can see expense ratios on your 401k take work. Like you guys can just, it's something real quick, right? Over here, I just looked at the funds that my company does, and I try to see what those numbers would add up to and how much I would be losing. From this 0.01 to 0.05%, I think would be pretty small. So for someone, let's say I didn't know much about the stock market, I would probably even pick one of these target funds where I'm just paying 5 times more than here, but that 0.05 would probably be a few $1,000s more, because this is 0.5%, and a target fund of 0.05% would be way cheaper. So let's talk about the target funds, just so you guys understand how they work. So here I have 3 target funds. I have a target fund for 2020, so that's assuming I'm retiring this year right now. Then I have a target fund of 2040, target date 2040. So that means I'm retiring in 20 years from now. And then I have a target fund of 2055, which is more like me, where I'm retiring in about 35 years. So now we'll take a look at the allocation of how it works. There's plenty of rules online, but there's these few golden rules that people follow. The first one is the amount of stock in your portfolio should be 120% minus your age. So let's say me that I'm 20, it would be 120. I'm 27, but let's just say I'm 30. All right, let's say I'm 30. So if I'm 30, it would be 120% minus 30 will give me 90. So 90% of my account should be in stocks, 10% should be in bonds. Now let's go. If I was 40, 40, it would be 120 minus 40. It would give me 80% in stocks, 20% in bonds. And let's say I was almost ready to retire. I was 60 years old. It would be 60% in stocks and 40% in bonds. And obviously, this is just golden rules. There's other golden rules. You can Google online to see like what's a good type of portfolio management. So right now, you guys can see the difference between target funds, right? If you're closer to retirement, you're gonna see your bond portfolio. You're gonna have more bonds in your portfolio opposed to stocks. If you're way further away from retirement, you're gonna see a lot less percentage in bonds and a lot more percentage in stocks. So let's take a look at the next slide, and this is how I would do it. So this is not how I would. If I'm young, right? I'm young. I'm 27 years old. Time is on my favor. So I don't need bonds, right? If we look at my 2055 retirement target fund, it says 10% bonds. But for me, I don't care about how volatile the market is right now, right? If the stock market crashes tomorrow, for my 401k, that'll be okay, right? That just means I get to buy a lot more cheap, very cheap shares, right? I would be able to get more undervalued stocks. So right, I'm using 10% of my money to be less risky or less volatile. But that 10% can actually be working in stocks to be able to give me more returns. Because at the end of the term, stocks have a higher average returns than bonds. But bonds usually are less volatile. So volatile, that means that bonds don't go up and high or low as stocks, but right? So if stocks crash, they'll crash pretty low, but bonds would probably only go down a little bit, right? So that's what you end up paying off for. For better returns, you end up having a more volatile system. With less return, your investments don't go up or down as stocks. So right, but at the age of 27, I don't care what happens to the overall market in the long term run, right? Obviously, it would be horrible if people start losing jobs. But in the aspect of your 401k, you have time on your favor. So I would do 100% in stock market equity. So like you guys saw, my index fund, right? I'm invested right now. You can see the big check mark right here on the S&P 500 index, which actually charges me the lowest gross expense ratio. All right. So like I said, it depends on the age you are. If you are younger than me, then I think it would be okay to be in 100% stock market equity. If I was older than I am now, it would depend the type of age. So I personally don't think I'm gonna go into bonds until after early or mid 40s, right? After early or mid 40s, I still have 10 to 15 years, right? So between now till mid 40s, I'm gonna be 100% in stock market equity. When my mid to early 40s, that's when I would start beginning to move my paychecks to deposits to bonds. So, all right, if you looked at your 401k, it asks you how much percentage of what do you want to go where. So right now, 100% of my paycheck on 401k goes to my S&P 500 index fund. But let's say when I hit my age of 45 or 40, I'm gonna start putting less money in my S&P 500 index fund and maybe do like a 50-50. The reason I'll do 50-50, right, is because I've already built up a strong portfolio of funds of the S&P 500. Now I want to start building up a new fund of bonds. So I might do 50-50, and every year from there I might put less in stock and more in bonds in my paycheck. So maybe once I hit 47, it'll be 45-55. 45 in stock market, 55% in bonds. What's another thing I would do? So let's say what about my equity in the S&P 500, right? So by that time I would have hundreds and thousands of the S&P 500. So what I would start doing, if I have too much equity in the S&P 500, if the market is good, if the market is really strong, I will start selling out of my S&P 500 and move a little bit into bonds, a little bit each year, right? So a little bit, let's say, so eventually my portfolio will start building up to a little bit less stocks and a little bit more bonds. But remember, from the age of 27 to 45, I was 100% in stocks, right? So I was just making that money work for me. Now I'm like, okay, I'm going to start retiring soon. Let me start building my portfolio and changing it little by little. And the reason I'm starting at mid 40s is, what if the market is bad? If the market is bad, I'm still able to wait it out for some time, right? Let's say if I waited for at the age of 57 and I still kept 100% stock market. What if at the age of 57 the stock market was bad? That means I have lost so much value just because of a bad stock market, and it doesn't give me any more time to help out. But at the age of 45, if the market is bad, I have enough time to wait up the market to be good. And once the market is good again, I'll start selling that index fund, the S&P 500, and again be remodeling my portfolio for less stocks and more bonds. So like either every month or every quarter, I would sell a little bit of my S&P 500 portfolio and increase my portfolio on bonds until by like the age of 50, 55, I have a healthy portfolio management of bonds to stocks. And to be honest, at the moment, right, this is for me at the age of 50. So at the moment, I don't know what the perfect balance will be. I just know that I have from now to the age of 40 to know that I should just be invested 100% in stock market equity. So that gives me 13 years for me to figure out what I want my bond portfolio to stock portfolio to be. And that's something that I personally know I can figure out by then. If I didn't know that, what I would actually start doing is, instead of putting it in bonds, I would start putting all my money, all my paychecks, right? If once I hit 40, I would start 100. I would clear 100% of my S&P 500 and put 100% onto my target fund, because I know my target fund is investing into bonds as well, depending on my age. So now that's going to be increasing my bonds, and just the same thing how I was doing here, right? If the market is good, I start selling out of my S&P 500 investments and start buying my target funds, and like that, eventually, I would be building up. I would be building up the perfect balance in S&P 500 to stock market to bonds ratio. So I hope you guys enjoy, like this episode. This actually, I think this was one of the main reasons I started investments. I picked up a book and they talk about 401ks and they talk about expense ratios. So once I ended up learning about expense ratios, I'm like, I should not be paying someone this much more money for Billy. I don't want to be Billy or Bob. I want to be Jose. That's me, right? Remember my expense, right? Front one is Jose, then it's Billy and Bob. I don't want to be Billy and Bob. I want to be Jose that keeps his full $1 million in his 401k. I don't want to be Bob, even though he only paid $100,000 less. $100,000 less. That's $100,000. That's half a mortgage right here in New Jersey. That's probably a mortgage in Florida, probably a mortgage in Alabama or somewhere. Imagine now, Billy, he has $300,000. $300,000. That is ridiculous. So I did not want to be those guys. I wanted to make sure that I wanted to keep all my money, and that's what I learned. So I hope you guys enjoyed this episode. We learned about expense ratios. We learned about target date funds. We learned the difference between target date funds, like why are they different, what the years mean, and we learned how I would do it. So if you guys have any questions, feel free to post them in the comments. Let me know what you think. Now I have to think what I will do the next episode on. But if you guys have any suggestions, feel free. Take care, have a good night, and see you next time.